Hello everybody, welcome to the Leeb.com video for November 9th, 2011. Be sure to visit Leeb.com, Leeb.com to sign up for our free market forecast emails. Although uncertainty still overhangs Greece, the market has already turned its attention to Italy, which is also having internal struggles in the government, in addition to ongoing debt and economic problems. The new load of uncertainty, to say the least, wreaked havoc in equity markets across the globe today. Italian bonds have soared to their highest level since the euro system was implemented more than a decade ago. Now, to be fair, Italy has more assets to draw upon than Greece, and its banks are reasonably well capitalized, but given the much larger size of the Italian economy compared to Greece, financial turmoil there would have a far greater impact than a Greek default. After an impressive 5-week rally, stocks were due for at least a minor breather. The Italy situation certainly creates a logical reason for some profit-taking and paring down of risk. But barring further deterioration in the Europe situation, we think that a major correction is unlikely, especially given slightly better economic readings here in the US, solid earnings results for corporations so far in the third quarter, I should say, and the prospects of further monetary easing from the Federal Reserve if necessary. Now note that despite a sea of red across the board today in equity markets, major resources like gold, silver, oil, and copper held their ground. In the case of gold, don't be surprised if the yellow metal ends the year closer to 2,000 than 1,800, and 1,800 is slightly above where we ended the day today in terms of the price of gold. And helping the more economically sensitive resources like copper and oil, today is China's CPI report for October, which showed that the inflation rate had slowed down to 5.5%, which is the lowest rate in almost half a year. Government officials there have stated that they believe that the inflation rate will be actually less than 5% for November and December. And of course, an easing of inflation will allow officials to give them more leeway to selectively stimulate certain parts of the Chinese economy, in effect, reducing the risk of the so-called quote-unquote hard landing that many China bears have been gleefully predicting. A healthy Chinese economy, of course, means plenty of demand for the world's natural resources, which makes them very sensible investments during times of uncertainty as well. While with growing demand, the baseline will simply get higher and higher over time. In other words, even if they drop during periods of gloomy economic outlook, resource prices will decline less and less each time, and their upside is outstanding, to say the least. That's it for today. Thank you for watching, and join us again soon.